Let me ask you something. When you analyze an investment deal, are you analyzing the property or are you analyzing the capital strategy behind it? Because if you're trying to build long-term wealth through real estate, the loan you use at the beginning should not be the same loan you use at the end. And this is where most beginner investors get stuck. They focus on the interest rate, but serious investors focus on the structure. In this video, I'm going to break down when to use hard money, when to transition into a DSCR loan, and how using both strategically can allow you to scale instead of stall. If your goal is to build a rental portfolio, not just do one deal, this matters. Let's break it down step by step. Before we talk about loan types, let's talk about what actually goes wrong. Most beginner investors try to use one loan for everything. They buy the property, they renovate it, they try to hold it, all with the same financing mindset. That creates friction. Either the bank won't approve it because of the condition, or the deal moves too slowly and they lose it. Or the long-term numbers just don't make sense once the dust settles. The issue usually isn't the deal, it's the structure. And understanding phases is everything. Let's start with phase one. Hard money is designed for speed and flexibility. It's asset-based, it's short-term, and it's built for properties that traditional lenders won't touch. Distressed homes, heavy rehabs, auction purchases, off-market deals that require quick closing. The rate is higher, the term is shorter, but it's not meant to be permanent. Hard money is a tool. It helps you control the asset. It gets you in the deal, but it's not where you stay. And this is where most investors make their first mistake. They treat hard money like a long-term solution. It's not. It's phase one. Now, let's talk about what happens after the property is fixed. There's a framework investors use called the BRRRR strategy. Buy, rehab, rent, refinance, and repeat. The refinance phase is where long-term wealth is built, because once the property is renovated and rented, it becomes income producing. And that's when you transition into a different type of financing. That's where the DSCR comes in. A DSCR loan qualifies the property based on its rental income, not your W-2s, not your tax returns. It looks at whether the rent covers the debt. This allows investors to scale beyond traditional income limits. It removes personal income bottlenecks, and it allows you to refinance short-term capital into long-term stabilized financing. This is how you move from flipping properties to building a portfolio. Now, let me show you what this looks like in a real-life scenario. Let's say you find a distressed property at $200,000, and it needs about $50,000 in renovations. The after repair value of this property is projected at $325,000. A hard money lender offers you 80% of the purchase price and funds through the rehab. 80% of $200,000 is $160,000, plus $50,000 for renovation. That's about $210,000. You bring 20% down, which is $40,000, plus closing costs and reserves. So realistically, you might have around $55,000 into the new deal total. You renovate the property. It appraises at $325,000. Now you place a tenant at $2,500 per month, and now it's stabilized. This is where structure matters. You refinance into a DSCR loan at 75% of the new value. 75% of $325,000 is about $243,750. You pay off the $210,000 hard money loan. After refinance costs, you recover roughly $30,000 or more. So now, instead of having $55,000 permanently tied up into the deal, you may only have around $20,000 to $25,000 left in long-term capital, and you still own the property. So here's where it gets interesting. Let's say your new DSCR payment is around $2,000 per month. The rent is $2,500. That leaves you roughly with $500 before expenses. Conservatively, maybe you net $300 to $400 per month after reserves and maintenance. So what just happened? You recovered a large portion of your capital. You created monthly income. You still own a $325,000 asset. And over time, that property appreciates while your tenant helps you pay down that debt. That is leverage. Now, imagine that another distressed property hits the market. Because you structured the first deal correctly, you now have capital available. You're not stuck. You're not trapped in a short-term high-interest debt. You're not waiting years to save again. You can move. And investors who can move quickly often get better opportunities. This is how one deal turns into two, and two deals turn into four. Not because you had unlimited money, but because you recycled capital strategically. This isn't about hype. It only works if your rehab numbers are accurate, if your ARV is realistic, if the rent truly supports the refinance. That's why underwriting upfront matters. But when done correctly, structure creates freedom, and freedom creates opportunity. When someone asks me which loan is better, hard money or DSCR, the real answer is neither. They serve different purposes. Hard money helps you control and transform the asset. DSCR helps you stabilize and scale it. When used together correctly, they become a growth strategy. If you're analyzing a deal right now, don't just look at the purchase price. Map out the entire capital path. How are you entering the deal? How are you exiting phase one? Does the refinance make sense? Does the rent support the debt? Because if you structure it correctly from day one, you don't just complete one deal, you create the ability to repeat it. If you want help mapping out the capital strategy on a property you're considering, reach out. Let's build it correctly from the beginning. And as always, thank you for tuning in to Francisco's Key Insights. I'll see you next time.